So 8:30 in the morning, that opening price, I'm bearish. I'm thinking we're going to go down below that green level there. That's the old daily low. So on this candle here at 8:30, I'm expecting all this being a fake rally. It's something to lull in traders to chase it going higher. The retracement, people that don't really understand order blocks, they're going to say, look at that, it's a down closed candle. I'm going to buy that. And then when it starts to go up like that, they feel, wow, this is really easy. Every down closed candle after a run up is a bullish order block. It's not. In here is the real context. Okay, we have an imbalance there. And that's what I'm looking at. I'm looking at this imbalance right there. So I'm trying to operate inside of that range for a short. Now, I know because of the volatility, it can color outside the lines, and it's okay. The bodies of the candles are kind of supporting the idea of what I'm looking for, but the wicks I could care less about because I want to get in when it's ideal. And I'm going to show you what that was looking like for me at the time. So we're going to drop down into a 4-minute chart. Okay, so here is that imbalance and fair value gap on the 5-minute chart, but now it's a little skewed because it takes up 2 candles to show that range. The market trades up, and right in that candle, that one right there, that's where I'm going short. I got in at 10:33. Okay, that was my short. Dropping down into a 3-minute chart. Okay, the market trades up, works inside that imbalance, and right there, 10:33, that candle, when it's starting to bump up against the top end of that fair value gap, right there, as it hits that and starts to move away, I'm in there. I'm going short right there. The reason why I'm trusting that and not thinking it's going to go higher is because we have this high here, okay, and then we have this high here. Which high is higher? This one or that one? Obviously this one. Now, this candle's high. Watch what happens. From this high, we have a short-term swing high next to it here, and then we have one here. So this one makes a intermediate term high. So we have a long-term intraday on a 3-minute chart, which sounds like an oxymoron, I know, but long-term high, intermediate term high, because this high is lower than that one. But we have a swing high here and here that are lower, both being lower than this one. Then we have the same context right here. We have a high with a lower high on either side of it. So I have market structure behind me showing that this is, number one, it's a bearish market because my draw on liquidity is down here. It hasn't traded down there yet. Okay, so it's going to act like a big magnet. So all these fluctuations in here, without understanding what I'm showing you, it's going to feel like it's just noise. It's chop. It's not. It's actually telling you exactly what it's going to do. So the swing high here is an intermediate term swing high. So I want to be going short real close to this high because it's likely to break like it does here. So at 10:33, when it hits the upper end of that fair value gap, I have at this moment, go back one candle. We have this high, a higher high, and a lower high. So we have a high with a lower high on either side of it. That's a swing high. That is lower than this one. That is lower than that one. So it's far more than just, oh, he's just looking at lower lows, lower highs. That's what a myopic individual would come and watch this. So like when they see me put a rectangle on the chart, they're saying, oh, it's supply and demand. It's not. There's so many more factors involved that it's just not even in the same vicinity. Okay, so sparing all that, compare and contrast, because I've done a lot of that already on the videos on this YouTube channel. What you're looking at is a price chart with a directional bias, okay, something that's leading to a draw on liquidity. So I've already told you last week that we were going to go below that green line. That's where we were heading. So what you're doing is you're looking at all the swing highs. And every time you see a swing high, and a swing high is simply a high that has a lower high candle to the left of it and a lower high candle to the right of it. And the one in the middle, that's your swing high. But by looking at that relationship of the highs, I trusted this because we had a swing high here already in effect. And I know that this candle here is not likely to go above this one because this one didn't go above that one and this one didn't go above that one. Not because it's lower lows and lower highs. There's much more going on underneath the surface than just lower lows and lower highs. That's just, it's cringy when you hear people talk like that and they try to reduce it down to something like that, or it's a support resistance idea. It's just buy the floor and sell the ceiling, okay? Or why doesn't ICT look at this trade over here and this trade? Because those trades are being referred to in hindsight by those people that talk like that. I'm literally taking live trades. I'm taking them, I'm executing on them, and I know why I'm doing it. I'm not guessing. I'm not trying to figure out or deciphering what it is after I get in a trade. I know what I'm looking for, and I know why I'm waiting for it. That is something that you learn by developing patience and trusting a model. The only way you trust it is to go through back testing. But if this is the candle I'm trying to get in at, and I execute on, with all the understanding of this outline there, I want to see displacement. We get it here. Now, if I didn't take this trade here, I could trade with the return back to this right here. Why? Why is that possible? We have a swing high. It's broken to the upside. This low is taken out here. This candle's high here. If it touches that again, I can be short there. Just using the imbalance in the fair value gap entry technique I'm teaching you. So I can go there and get short, or I want to get up here as close as I can to that important high that I've already outlined here. So I want to be in that and wait for that initial move, because then when this occurs, when you're that high up in the session high. So at 8:30, right there, this run up, I'm real close to this high by entering there. Notice that? I'm not waiting for a breakout below that low. So I'm getting up in there where it's an optimal entry. I don't need to get the highest high. You don't need to get the highest high. But you need to understand why it should be trading away from the levels you're trying to enter at. And that's kind of like what I'm showing you here. I'm hinting at a deeper lesson I'll give you on Thursday. But the displacement comes, which is what I was waiting for, and it gives you a confirmation. When this occurs, it's just almost like, okay, just sit back and just relax and just let it do its thing. Now, Monday, again, was a holiday. So I knew I had abbreviated session hours. So it's going to close at 1 o'clock. So that's right in here. And then the next candle obviously would be 1 o'clock, and it's not trading, so it closed. But it closed here ahead of 1 o'clock, and then the holiday session closing at 1 p.m. in New York local time, and the low, that green level there. Remember, go back to the daily chart at the beginning of the video and what we were referring to last week. The liquidity, the sell stops below this green line, that's where it was going to attack. Okay, and it came in and did so. It opened up 6 o'clock in New York time. It opened up and slammed down, accelerating lower. That is the move that you want to see, being short up here and covering down below here. Once it does that and it runs into low deep, that's it. You take your profits and move to the sidelines and then wait, because you have a big gap here. It's likely to come back and rebalance that and fill it in.